One of the things I have to do as a short-term trader is to look at both scenarios. I have to be comfortable taking trades in both directions and see where the maximum trades and the maximum risk could be. And if you study technical analysis, you study something that's called a Megaphone pattern, and it's a widely diverging pattern. We continue to see this in the markets. Markets continue to diverge. There is a mindset of what should be and what was in the past, and it continues to oscillate in this Megaphone pattern. As of the end of 2017, we saw a spike up, then we saw a pullback, then a higher high, lower low, higher high, lower low, higher high. What's next? We see scenarios where the worst month is followed by the best month, and now we have the best month since 1984 in, I forgot which index. And so we have this best month since 1984. Well, we now have the worst month. And so we're in a world of mean reversion, a lot of volatility, a lot of news events. And so see the VIX spiking up 13% today. And so while we finish strong on the month, we have to consider bearish scenarios as well. So I want you to be aware of this pattern. We've talked about Nasdaq 25,000. This is a chart of the S&P. And so the Nasdaq could go to 25,000. We could see a huge surge higher. And we want to be aware of the limits of these moves. And so oftentimes as short-term traders, we think, well, the market can't go that far. It couldn't go that far. We have to think in terms of how far it could go so we can stay with the trades. We have to consider trades in both directions. And so we could go to 25,000 in the Nasdaq over the next 18 months. Or we could see this market violently reverse as we go into the election. We've seen that, faster and sharper drawdowns. And so we have to consider both these moves. So we're willing to take both types of trades.